I'm Habib Kairouz from Rho Ventures. I'm a managing partner at the firm. We've been around for 25 years. The firm was set up back in 1981, at the time to manage the assets of one family out of Europe. And we got into the venture business literally back in 1981, investing both directly in companies and in third-party private equity funds. In 1993, we opened up the firm to outside capital. That's when I joined the firm, so I've been doing this for 15 years now. We manage $2.5 billion today, a third in the fund-to-fund activity and two-thirds in our direct activities. Since '93, we've raised 6 funds. We just closed on a $550 million fund. And in the Rho Ventures side of the business, which is the area that's more relevant to this conversation, we look to deploy approximately $25 to $30 million per company over the capital formation curve. We're stage and sector agnostic, so we'll go from seed all the way to pre-IPO. We've done a couple of pipes. Fundamentally, the way we look at the world and our investment activities is that if we're doing early stage investing, we need a minimum number of companies in the portfolio to adjust for the risks. We assume that every investment we make could go to zero, and that's part of the business, but every investment needs to be able to return a 10x for us. When we look at a later stage investment, we can't assume that we're going to get a 10x by going in at a $100 million valuation. So the parameters from a cash-on-cash standpoint are a minimum of 3 times our money on any investment. But fundamentally, regardless of how we deploy the capital, we're looking for a minimum return of 40% on our cash. In terms of the sectors that we invest in, we're looking for fundamentally high growth sectors that we can bet on a high growth for the next 10 years. We're looking at companies that are growing at a minimum of 40%, that are riding a wave that's also growing with them. So we'll change our thinking based on which sectors we want to be exposed to at different points in time. We'll change our thinking as to what stage we want to be involved in within specific sectors based on where we're seeing valuations and where we're seeing excesses of capital chasing valuations. So you could see us doing early stage biotech in one vintage fund and doing later stage new media companies in the same vintage fund. Right now we're spending a lot of time looking at companies in the new media sector, specifically in traditional media where brands have been built offline and are starting to look to migrate to the online world. We're doing a lot in wireless infrastructure technologies as well as applications in energy technologies, biotech, and obviously the traditional software sectors. I've personally spent a lot of time in New York companies. So I've been on boards of companies like iVillage and Takoda and Tripod and Intralinks and Waterfront Media, Reach Locals on the West Coast, the Travel Ad Network also in New York. So I'm very focused on spending time on companies in New York, and I think there's a great opportunity in the New York sector, especially in the new media sector, given that the ecosystem is here. We have offices in New York, Palo Alto, and Montreal, and that's it.